It's 1983. The US is clawing its way out of a deep recession. Inflation is slowing down, interest rates are still sky high, and investors are unsure whether to hope or panic. And in the middle of this chaos, Warren Buffett writes a letter so profound that, 4 decades later, it still holds the blueprint for building generational wealth. In the next few minutes, you'll uncover 5 rare investing principles Buffett shared in 1983, paired with real examples from today's markets. These lessons are more relevant in 2025, a time of AI booms, tech bubbles, and economic uncertainty. If you're serious about building wealth with clarity and conviction, hit that subscribe button now. This is timeless strategy, not fleeting trends. Let's rewind the clock. In the early 80s, inflation had hit double digits. Volcker's interest rate hikes had cooled demand but also crushed markets. The US was recovering cautiously. But instead of playing defense or chasing the latest market rally, Buffett wrote a shareholder letter that focused not on market predictions, but on permanent investing principles. And that's the first thing that makes this letter different. It doesn't age. It adapts, even to the world of 2025, where AI stocks, defense manufacturing, and green energy dominate headlines. So let's step inside the mind of the Oracle of Omaha and discover what really matters in any market. Buffett begins not with numbers or forecasts, but with mindset. Buffett says, "Charlie and I think of our shareholders as owner partners and of ourselves as managing partners." To Buffett, a shareholder isn't a ticker-chasing gambler. They're a co-owner of a real business. This philosophy led him to make decisions not based on quarterly stock movements, but long-term business value. Think about long-term investors in TCS or Infosys. They didn't react to every market dip. They acted and held like owners. But mindset is just the beginning. To invest wisely, you also have to know what not to trust. Starting with earnings. That takes us to lesson 2, intrinsic value over earnings headlines. Buffett writes, "We virtually ignore consolidated reported earnings." Why? Because reported numbers often mislead. What matters is intrinsic value, the cash the business can generate over time, not just what shows up in quarterly PDFs. In 1983, Buffett was investing in GEICO, where he saw massive value even if it wasn't fully visible on the balance sheet. Today, think of Page Industries or Nestlé India. Their earnings look modest, but their real power lies in their brands and consistency. Don't chase earnings, chase cash flow, return on capital, and management integrity. That's where the long-term money is. And that brings us to one of Buffett's biggest investing transformations, one he openly admits in this letter. Lesson 3, bet on economic goodwill. "I used to favor tangible assets and shun goodwill," Buffett says. "That bias led me to make many mistakes." But over time, he realized the most valuable businesses aren't the ones with the most factories, but the ones with the most customer love. See's Candies, which he bought in the 1970s, didn't have heavy machinery, but it had loyalty, brand trust, and pricing power, a rare combination he later called economic goodwill. Think Asian paints. People don't say paint, they say Asian. That's goodwill, that's Moat, that's pricing power. But here's the catch. When you find such a business, the hard part isn't buying, it's not selling. That naturally takes us to lesson 4, don't sell great businesses. Buffett was clear. Regardless of price, we have no interest at all in selling any good businesses. Most investors get nervous when their stock doubles. Buffett, he gets excited because compounding just began. Early investors in Titan who held through every dip, they didn't just make 2x or 3x. They made 20x because they didn't interrupt the compounding engine. If the business is still growing, still efficient, and still loved, stay on the train. The real money is made in years, not trades. And yet, even the best business can't save you if you're constantly being distracted by market noise. This brings us to the final lesson. Avoid the stock market circus. A hyperactive stock market is the pickpocket of enterprise. Buffett calls out the real problem, activity. The financial world praises liquidity and marketability, but all that movement comes with a cost. Think of those who bought Paytm, Zomato, or hot AI stocks on social media buzz, only to sell in panic months later. Buffett refused to even split Berkshire shares because he wanted to repel speculators. In 2025, when everyone's chasing the next 10x, the smartest move might be doing nothing. You don't need more information. You need more discipline. And that discipline is what helped Buffett outperform entire industries, including his own. In 1983, the insurance industry was bleeding. Combined ratios were over 110%, meaning insurers were losing money even before paying operating costs. Buffett admitted, "I made serious mistakes, but GEICO, which I didn't manage, shot the lights out." Lesson: back great managers, let them work. 2025 parallel. Look at India's reinsurance and fintech leaders like ICC Lombard, lean, data-driven, resilient. The playbook hasn't changed. Buffett's final reflections in the letter are less about stocks and more about shareholder character. Final reflection. Buffett writes, "We try to attract those who think of themselves as business owners and discourage those looking for action." In a world of dopamine hits from trading apps, this feels radical. But it's right. Long-term wealth doesn't come from chasing markets. It comes from understanding businesses, backing the right teams and staying invested. Markets may change, but temperament is your edge. 1983 gave us more than a shareholder update. It gave us a playbook, one that still outperforms today. Whether you're investing in Indian midcaps, US tech giants, or global ETFs, Buffett's principles still apply. Think like an owner. Ignore the noise, trust Goodwill, stay the course. If this video helped clarify your investing journey, subscribe now and join a growing tribe of rational thinkers. Your future portfolio will thank you. The chains of habit are too light to be felt until they are too heavy to be broken. Break the bad ones, build the good ones, and invest like Buffett, even if it's 2025.